Hey everybody, hope everyone is doing well and had a good day today. In this video, I will review the Emini 5-minute chart for Monday, July 21st, 2025. And I just want to talk about the 5-minute chart today very briefly. We had the gap up going into the day, big gap up with follow through far above the bars to the left. The bulls will probably get some kind of follow through. The danger on the open with breakouts, you've heard Al say, 50% of the time breakouts on the open will reverse no matter how strong. But if we look at the Globex chart, what was the context of this bull breakout going into the day? Well, we had a bear channel. We had a bear breakout of a bear channel. And the expectation is a reversal back up within 5 bars and a test of the trend line. Here's the breakout. Here's the reversal within 5 bars, and here's the test of the trend line. But the market does not have to stop here. The bears can argue that they're in control with this bear channel, but is there a reason to sell on bar 1 other than the fact that the market is testing a bear trend line? Well, the reversal up looks strong enough for a second leg, so at a minimum, if you're looking to sell, probably better to look for a second entry. And in this case, the bulls were relentless, bars 1 through 3, even if you had only the gap up and not the Globex information, 1 through 3. Very strong bull breakout, probably will get a second leg. And it's probably by the close 2, by the close 3, by the close 4. 4, a little climactic, but still more follow through on 5, and really no reason to sell here. There's reasons to sell to take profits. Bar 4 might have been a profit-taking bar for the bulls, but the pullback relatively shallow, and then the next bar closing on its high. It's another buy the close bar. Bulls will trail their stops. And again, the buying here was relentless. Very high probability that the bulls get follow through and that the first reversal will be minor. So traders will buy for any reason and buy the first pullback. So here's the first pullback below bar 7. Traders will buy it and probably will scalp at the new high, because at this point, the market's in the breakout phase until there's a pullback. A pullback when a bar goes below the low of the prior bar, which we had here on bar 9. As soon as the market pulls back, the breakout phase is over, and we are either in a channel phase, a bull channel, or there's a reversal underway. The bears have a reversal, potentially. But like I said, after this much strong buying, the probability that the bears get a V-top major reversal here, probably maybe 30%. And basically, what I'm saying is that it's very unlikely. Bulls will buy the first pullback and very likely get a scalp out of it for capturing a piece of the second leg. And we quickly rallied to a new high. But at this point, when the market's in the channel phase, unlike the breakout phase where traders are buying and pressing their position, buying for any reason, once we pull back and the market's in the channel phase, the bulls become more efficient. The bulls are buying pullbacks and taking profits at new highs. During the breakout, the bulls are buying new highs. They buy above the bar, buy above the bar, buy above the bar, all the way up. But once it pulls back, the bulls switch to basically scalping and trading the market in the channel phase. So entering on pullbacks, taking profits at highs. So big trend bar 11, but expectation at least a pause, because we broke out to a new high. The market's in the channel phase. And rather than buying new highs, bulls are buying pullbacks. We also broke out of an inside bar. Inside bars usually get tested before very long, so we may have to come back and test the high of bar 10, the breakout point of that inside bar. Weak follow through, basically a doji bar, much smaller body, probably profit taking by the bulls, but still really no reason to sell. Very aggressive to sell here. This is a bull trend. And we get a reversal bar 13. Low probability sell. Traders selling below 13 know they're taking a low probability trade. They have small risk, stop above the bar. Let's say you enter on a stop below 13. You really want to make at least twice your risk, maybe even 3 times the risk, if the probability is only about 40%. More often here, the market will pull back, but eventually run the stops above 13. In other words, it will remain in the channel phase. The bull trend will remain because markets have inertia and they resist change. And they always look like they're reversing. The market's always trying to reverse. You can call 13 a second reversal, but the bulls just got a breakout and follow through to a new high. Bar 9 is the new major higher low. So bulls can buy for any reason, stop below 9, and scale in if this goes against them. 13 is a strong enough signal that maybe the bears will get a second leg down. And like I said, there are support areas to test below. So maybe bulls look to buy lower. Again, they're being more efficient. Maybe they'll buy a 50% pullback, maybe a 75% pullback. Again, sorry about that, maybe the high of bar 10. They're not buying at the highs anymore. So this is probably reversing down because of a lack of traders willing to buy. Bulls are buying pullbacks, bears are selling up here and looking to buy back shorts lower to make scalps. But it is a tight channel at this point, so probably better only to look to trade in the direction of the trend. Weak follow through bar, so 13, good looking bear bar, but totally overlapping 12. 13 is an outside bar, and that reduces the probability for the bears. It's better for the bears if there's some distance with the breakout, but there's really no distance on that breakout 13 because the bar is overlapping the prior bar. So lots of overlap. 13, bad follow through. 14, 15, better for the bears. That's what I meant by distance. At least the bar went far below the low of the prior bar. Now the bears have a 3-bar micro channel, a bad buy signal. 15, probably sellers above. Second leg down likely, but this is probably a minor reversal. And again, bulls can buy for any reason here. Stop below 9, expecting a test of the highs before a stop run below bar 9. So 16. Now 16 might actually be a third push down. We have 13, pause, 15, pause or pullback on the same bar. It went down, it went up, and then 16 going down again. So 1, 2, 3. It is a 4-bar micro channel. There's not really a strong buy setup or signal bar, 16. So the probability here is probably closer to 50-50, but it still favors the bulls because of the context. The market's in a bull trend. We just had a breakout to a new high, and we have a weak looking reversal attempt. 4 consecutive bear bars. At this point, the market is either in a channel or a trading range. We know it's in the channel phase, but it also might be in a trading range. And if that's true, there's probably sellers above 13, and the market could come back all the way down and test this area. The low of bar 9, maybe the stop order price in here, somewhere within here. 17, testing that inside bar, probably support. Again, 1, 2, 3 pushes down, but no decent stop order. And 5-bar micro channel, probably sellers above 17, but risky, dangerous to be selling here when there's already been 3 pushes down in this structure. You're trading against the direction of the major trend, and the bulls will probably get at least one more leg up in a test of the highs. 18, a strong breakout bar, but lots of overlap. And after that 5-bar micro channel, hesitation is expected. I think it's okay to buy 18. If you sold for any reason, you probably exit above 18. Always in bulls buy above 18. Maybe buy in the buy zone of 18 as well, because you expect hesitation after 5 bars down. The bears need at least some kind of a second leg, which is what happened on 19. Very subtle, but there's a pullback to the buy zone, the midpoint of bar 18. And that hesitation is expected. So if you bought, do you panic out of longs? No, you expect the hesitation, but ultimately you expect the market to test the highs of the channel. So more hesitation, but still a minor reversal. Bulls probably will get the test of the highs, but I suspect there are sellers above 13 if we get there. Bears who sold, like I said, they knew they were taking a low probability trade. They sell below 13 with small risk, huge reward potential, but that always is accompanied with low probability. So what about selling below 22? Is it a lower high, major trend reversal? We have a bull trend line break. Let me clean up the chart. Maybe I'll redraw these lines in a moment. I'll keep that one. Bull trend line break, two-legged retest of the highs, and sell below 22. Again, if you're selling 22, your stop is above either 22, 21, or the current high of the day, 13. Relatively small risk for big reward. You really want to make at least twice your risk on this trade. If you're selling here, you're selling in a bull trend. The lower high major trend reversal argument is fairly weak. Yes, the bears had a 5-bar micro channel, but is there a significant break of the bull trend line? And is this a strong price leg? Or is it comprised of doji bars and overlap bars with tails below? Where are the consecutive strong bear bars? We did not even test the moving average. So all this is probably minor, which means a leg in a bull flag or a trading range. That's why I think the magnet 13 is probably, at this point, still probably going to be reached. So if you're selling below 22, you're taking a lower probability trade. And the trade-off is you get a fantastic risk-reward ratio. So probably going higher. You can see nobody sold below 22. The market did not get below bar 22. And then we got a bull breakout to a new high. Like I said, probably sellers up here. And look at the structure here. Bull breakout, pause, bull breakout, pause, bull breakout, pause, bull breakout. 25 is actually a bull breakout of a bull channel on a smaller time frame, this structure. And it's also leg 3, even if we just count spike breaks. Leg 1, pull back. Leg 2, pull back. Leg 3. And then here, 1, 2, 3, 4, or 1, 2, 3. Either way, 25 is a late leg in an area of resistance where there's probably sellers. So 25 is a profit-taking bar for the bulls to me. 26, bear bar, not all that strong, but strong enough that if you're long for any reason, you probably just exit below 26. There's too much risk of a bear breakout because we have 3 legs up and the bull breakout's getting progressively weaker. Very strong rally up to bar 7, but the second leg much weaker, 9 through 13, and this one even weaker. Covering less points, comprised of more bars, more overlap. Where are the micro gaps? Plenty of micro gaps on the way up here. Micro gap created by bar 11 here, but here, this is a leg. This is more likely a leg in a trading range. So probably always in short based on context here because of 3 pushes up. And the expectation after 3 pushes up in a channel is 2 legs sideways to down, probably test the bull trend line, which might be down here. Bad buy signal 27, probably sellers above. And the bears, the more bear bars that get added to this breakout, the better. It's not all that strong, but the bears are controlling price and time, and it's not very climactic. Now we're testing the trend line on 30, 31. 4 consecutive bear bars, bad buy signal 31, probably sellers above. This breakout will probably get a second leg down. Like I said, after 3 legs up, probably we'll get 2 legs sideways to down. We have 1 leg down. First reversal will probably be minor, and then we need a second leg down to complete the structure. So bad buy signal, sellers above, sellers on the close of the bar, bear breakout. Bear breakout of a bear channel. It's opposite of bar 25 here. So bear channel, bear micro channel, and then breakout of the bear channel line. So the downside here, probably limited. Also testing support. Bar 19 was a major higher low 9, breakout to a new high, higher low 17, breakout to a new high. This is a major, sorry if I'm saying that backwards. 17 is a major higher low, broke out to a new high. If we come back and test below here, the bears will have broken below a major higher low, and at that point the market is either in a trading range or a bear trend confirmed. And that's generally speaking. More bear bars, bad buy signal 33, probably sellers above. Trading range bar, we have 3 pushes down to the support level, probably buyers below 33 and 17. The market looks like it's in a trading range at this point. Bull trend line break. We still need a retest of the highs or the bull trend line before there's any major reversal most of the time. Usually you need a trend line break and a retest before there's an opposite trend. Bear breakout 35, but late leg, breaking below a double bottom or triple bottom and support bar 17 low. So even though we have one of the best looking bear bars on the screen, it's occurring late in this swing down at support in an overall more bullish day. 36 probably similar to bar 26. If you are short for any reason, probably want to exit above 36, and traders can buy above 36 for a swing trade. 36, you need a swing trade because it's low probability. Many bear bars, no significant trendline break, small risk, big reward, always accompanied with low probability. So buyers above 36 probably need at least 2R, twice their risk, which takes you to a new high, or close to a new high. Reversal and follow through 36, 37. Good for the bulls. Structurally makes sense. We're at support in a trading range. And the bars 36, 37 are strong. There's probably buyers below, and a second leg up is likely. Probably buyers at the high of 36 and in the buy zone and below bar 37. $36, $37 is probably at least a minor reset of the leg count. Is $36, $37 a late leg? To me, it's leg 1. It's probably not a late leg. It's occurring at support in a more bullish environment, but it is after this big bear trendline break where this is the bull trend line, bears broke below it, and now we may get a test of it, and 36, 37 looks strong enough for a second leg, but the upside might be limited. So at this point, traders might be buying, betting that 38 is a bad low 1 coming after 36, 37, which needs a second piece. The bulls are buying, like I said, the low or below bar 37. They'll buy below 38, looking for a scalp, probably to at least the high of 38. And the first reversal attempt after a leg count reset has a high failure rate, so very low probability sell below 38, and that makes it a high probability buy. So buyers below 38 for at least a scalp up. We found buyers below 38, and the bulls got their second leg. The second leg was strong enough for its own second leg. So now we have leg 1, pullback, leg 2. We're testing near the high of the bull trend. The stop order below 26. We're in that area in the bull trend line. And like I said, since we fell below 17, the market at this point is either in a trading range or a bear trend, and this is a lower high major trend reversal setting up. But this is too strong to sell against. Bears need a second reversal. 42 low probability sell, but testing a couple of resistance areas. 43 testing that trend line and the highs. Looks like we tested the stop order price above 27. A couple of reasons to look to sell here. Aggressive to sell with a limit order after 4 or 5 bar bull micro channel, but reasonable. But you're probably using a wide stop. You're not going to sell. You're not going to buy back shorts at a new high. You're going to bet that this is a trading range, and this is probably sellers at a new high of the day. Or you can wait for a second reversal. You can wait for a stop order entry, stop order below 44, micro, double top, up, pause, up, down, stop order below 44, a reasonable sell, but low probability being a small bar in a tight channel. In the bulls, the 5 bar micro channel gets its own second piece, but we're testing resistance. We're in a late leg. We're at the top of a trading range. This is probably the sell zone. So anything that looks like a buy signal might be lower probability. You get breakout and follow through 45, 46. This might be a better fade because it's a late leg at the top of a trading range after a decent trendline break. Stop order sell below 47. Traders long for any reason, probably wise to exit below 47. You have a low 2, possible lower high major trend reversal, and flat traders or bears can sell or add on to their positions here. $48 a week stop order entry, but now we have really not a strong stop order buy above 48 either. We're at the sell zone resistance area of a trading range. Bulls getting a test of the 43 high. The market's in a channel phase like over here. When it breaks out to a new high, there's probably sellers here, which is what's happening on 49. We found sellers above, just like we found sellers above 13 on 25 and 26. 50 a better stop order sell than 47. It's a bigger trend bar closing on its low and reversing several bars to the left. Selling below 50, you're being forced to sell just above the EMA and at the bottom of this tight trading range with small risk, relatively small risk compared to your potential reward. So you're looking for at least 2R here. Selling not in an ideal location, so you have low probability but good risk reward, and that's the trade-off. Bears will sell here looking for a swing down. Bulls will buy hoping the tight trading range continues. This is a bull channel and we test back up to the highs. Bears get follow through. Bad buy signal 53 or 52 after bear breakout and follow through in decent context. There's probably sellers above. You know there are trap traders below 49 and even 48 because of bars 50 and 51. Bear breakout and follow through. Traders buying below 48, 49 got trapped. 52 is relieving them. 52 is like 38. To me, 50 and 51 is a leg one breakout for the Bears, and this is 52 is the first reversal attempt of that, but this is a fairly strong signal in good context. And when you have a fairly strong signal in good context, there's up to a 95% success rate for getting a second leg, and for this reversal 52 to be minor. So it's kind of like 38, 36, 37, bull reversal and follow through. Context, bottom of a trading range, several legs down, breakout below a triple bottom. Context and signal strong, first reversal, very likely to fail and lead to a second leg. So there's probably sellers on the close and above bar 52 for at least a scalp down. Bad buy signal 53, sellers above, and the market's in a channel, bear channel, spike and channel. Bears hope, like I said, bears hoping this is a major trend reversal, bull trend, spike and channel, trend line break, retest of the highs, and we get a lower high, major trend reversal here. What about buying 55? It's a low probability trade. It's a second reversal, you can call it a high 2, after the rally 36 to the highs. But it's a very small signal bar occurring in a very sideways market. You're about in the middle of the range, so you're forced to buy in the middle or upper third of the range with a small signal bar. Small signal bar means small risk, which always has low probability. Your reward is big relative to your risk, so you can make 2R, but you probably have a 40% chance of winning this trade here. In other words, 60% chance if you sell and look to run the stop below 55, which is what happened here. 1, 2, 3, or 1, 2, 3, 4 legs down. Might need a correction, but this is tight. It's probably sellers above 57. 57, like 55, is a bad stop order buy. More likely sellers above. There might be a correction, like I said, but this spike in channel structure is small, so we don't need 10 bars and 2 legs to correct this. The correction can occur in just 1 to 3 bars. So 58 might be the start of that correction. There might be buyers below 58 for a second piece, but this is all minor, occurring in a trading range. So like I said, low probability selling above, buying above 57, probably higher probability to sell above 57. And that's 2 legs up, 57, 58, and then 59 is a pullback and a second leg. So the channel with 3 or 4 legs down had a 2-legged correction. So to me, 59 is a sell to close bar. And you expect a test of the lows. And the bears may get a measure move down based on the height of this bear flag, the rally. And there's a good breakout bar with follow through, so probably sell to close here. This may have reset the leg count because we had a spike in channel with a couple of legs, sideways to up. Market was in breakout mode. We got the bear breakout and follow through, probably sellers above 62. Possible measuring gap 63. Magnets below. You can see my horizontal lines below. We'll stick with these two, 36 and 9 low. Is this a lower high major trend reversal? It's not clear yet. It might just be a trading range. There might be buyers at the 36 low. But then we get 64 surprising bar. Again, might be a measuring gap, which means maybe we get a measured move from here to here, projected down. The market fell below bar 9. The market's certainly no longer in a bull trend. It's either a trading range or a bear trend. What leg is bar 64? Here's a tricky thing with leg counting. Some traders will see it as leg 3. 1, 2, 3. And that's okay to see 3 pushes down like that. Technically, there are 3 pushes down in a bear channel like that. The problem is the momentum and the structure. Where's the stop order buy signal? It's okay to look to buy, but that does not mean you just set a limit order to buy here during a bear breakout because it's leg 3. Because the real risk here, let's think about day structure for a minute. Strong rally on the open, but then it was a spike in channel with bad follow through and converted into a trading range day. So one of 2 things will probably happen from here to the rest of the day. We'll either find support and we'll rally, maybe close near the highs, or today will be a reversal day. We rallied on the open. The bears are successful with their trendline break, lower high, major trend reversal, and we get back down near the lows. But probably one of those 2 things will happen today: bull breakout, trading range, or bull breakout and major reversal. It's unlikely at this point to me that we'll get strong trend resumption and close far above these highs. So okay to see leg 3 and to maybe want to look to buy, but you really need that buy signal, and until you get it, it's okay to be short. So what about buying 65? It's one of those low probability trades. If you're buying 65, you got to ask yourself, is 65 going to reverse this bear breakout? Also, let's say you enter above the bar, stop below the bar. You know you're getting at least twice your risk back on the trade. And if that's the case, your risk is small and your probability is low. Therefore, 65 might make more sense to sell to close or sell above than to buy if you want to trade on the higher probability side. Breakout follow through for the bears. This is now more clear that we have a reset of the leg count and we're probably going lower. Sell to close 67. The blue line is yesterday's high. The green line is the open of the week, the open of the day today, Monday. market raced down to yesterday's high. We might find temporary support here. I don't suspect we'll get a major reversal right after this, but we are testing a breakout point, the high of bar 3 created by bar 4, which is also the high of yesterday. So I do expect at least a bounce here. And 69 is that pause, and it broke far below that expected support area, at least for a bounce. And 69 is a bad stop order buy, therefore it's a good limit order sell. You can sell the close, you can sell above the bar for another leg down. If you sell above the bar, this is an example, you sell above 69, stop up here. Remember, probability has to do with equidistant moves. So what's the probability the market moves X ticks up before it moves X ticks down? The bears have directional probability here. Better to sell above or sell the close of 69 with a stop, a measured move up, and a target at the low of the bar. The bears very likely will get a second leg down, and 69 is probably not the low of this swing point. There's a weak buy above 69 with bad follow through, gaps remaining open, not a significant trendline break. The bull bars are small. This represents profit taking by the bears. And then the bears get resumption back down. The bulls never really had a buy setup. Outside down 75, but it's a big second leg, testing support. Probably will bounce here. The market's in the channel phase, spike, pullback, channel. Buyers below 69, buyers at the open of the day, open of the week. So we'll probably bounce here and continue sideways to down. And that was it for the day. So that's going to do it for today's review. Thanks everybody for watching and listening, and I hope everyone has a great night.